Good afternoon, everybody, and welcome to our latest tax update. Thank you for joining us. As usual, we will be recording this webinar, and so that will be available on our website a few days after today. You should receive a link via email to access it should you want to watch it again. Please feel free to ask questions as we go along using the Q&A function within Zoom, and we'll pick those up at the end if that's okay with everybody. And just the usual format today, covering business taxes, private client issues, and tax disputes and resolution matters. Now, usually Vicky would be joining us for the private client side of things. Unfortunately, she's just been called away from the office at very short notice. So good news or bad news, you've just got me for another 10 or 15 minutes or so, and I'll cover off Vicky's slides. So let's get cracking. We'll start off then with corporation tax and business taxes. And there are a couple of areas I wanted to just talk about today, and it's a reminder almost of two areas where are very important for sort of the SME sector. First of all, I'll be reminding us all around the annual investment allowance, but in particular, I want to look at how connected companies and connected businesses are treated as far as the annual investment allowance is concerned. And then afterwards, I'm just going to go through a reminder about the change in basis period provisions, which are coming in from next year. But it's important that where you have unincorporated businesses, we start thinking about that in more detail now. So first of all, let's have a look at the annual investment allowance. And just a reminder here for everybody, it was set at £1 million in January 2019, and initially that was going to be on a temporary basis. The last budget confirmed that £1 million is now permanent. And just as a reminder, the annual investment allowance, it applies to unincorporated and incorporated businesses. Excludes cars, that's one of the main exclusions in terms of the types of assets that can qualify for the AIA, and it can be used for new or second-hand assets. And so that's very different from the super deduction and full expensing, which has now come in, which applies to companies only, and only applies to new and unused assets. So the AIA has a wider application, both in terms of the sorts of businesses who can use it, but also the types of assets that can qualify. So let's look at how AIAs are treated when we're considering connected companies. Now, each company has its own AIA. However, where you have a group or a collection of related companies which are under common control, that £1 million AIA allowance is for the whole of that group or for the whole of those related companies. So what do we mean by these terms? So companies under common control are related to one another if either of the following conditions are met. So both companies carry on their trading activities from the same premises, or both companies derive more than 50% of their respective turnovers from activities within the same NACE classification, the nomenclature of economic activities. So this is a bit like a SIC code, but an EU version. And so, for example, if you had two companies under common control, which weren't in a group, one of them was in agriculture, one of them was in construction. If they didn't share premises, then those two companies would not be related for AIA purposes because they're within different NACE classifications. In respect of groups of companies, that's more straightforward in that group companies have one AIA, and so that's a parent company and its 51% subsidiaries. So when we're looking at related companies, we need to think about, is there common control? And so company or companies controlled by a person in a financial year, if it's controlled by a person at the end of that financial year. So you're looking at a test at the end of the period. Similarly, a group of companies is controlled by a person in a financial year if the parent undertaking is controlled by that person at the end of its chargeable period in that financial year. And when we're looking at control for these particular purposes, I mean, you're probably aware that control can have different definitions depending upon which part of the Taxes Act that you're looking at. But for the purposes of AIA, control means the power of a person to secure voting power in relation to that company, or as a result of any powers conferred by the Articles of Association or other documents of that body corporate. So a shareholders agreement, for example. So either through voting power or through shareholders agreements or other documents, the articles, etc. If they could control the affairs of the company in accordance with their wishes, that company would be under that person's control. When we consider unincorporated businesses, similar rules, but applied slightly differently because the concept of control, of course, is different for an unincorporated business compared to a limited company. So a restriction arises where in a given tax year, two or more qualifying activities meet all of the following conditions. So they're carried on at the end of the period for the activity ending in the tax year by a qualifying person other than the company. We're looking at unincorporated businesses here. They are controlled by the same person. And we'll come on to shortly in terms of what control means for an unincorporated business. And again, they are related to one another. So I'll come on to that shortly again. So where all of those conditions are met, and where the activities are all carried on by one qualifying person, that person is entitled to just one AIA. Where the activities are carried on by more than one qualifying person, those persons are entitled to a single AIA between them in respect of the relevant qualifying expenditure. So when we're looking then of the definitions of control and related, quite similar to how we look at things when we're looking at related companies. So a qualifying activity carried on by a partnership is controlled by the person who controls the partnership, and where partners who between them control the partnership, they are related to each other. So the qualifying activities carried on by the partnership are treated as controlled by the same person. So where you have two partnerships under common control, they will have one AIA between them. So qualifying activity, now that's related to another qualifying activity. Again, if we meet the shared premises condition and or the similar activities condition. And again, we're looking at these NACE classifications in terms of whether two activities are similar. And so where the two activities are related to one another, the first activity is also related to another qualifying activity to which the second activity is related in that tax year. That sentence didn't read particularly well, but basically, if you've got two activities where either there are shared premises or they operate in the same classification and they're under common control, then there's one AIA to share between them. Okay, just wanted to touch on now about basis period reform. And we just have one question just quickly come through about the slides. We don't circulate the slides anymore for the presentation to everybody, but if you would like a copy, more than happy to send them out to you. So if you just want to drop me an email, then I can send those out. You can access the webinar later anyway. Like I say, we are recording this. So having covered off AIAs, I'd just like to now spend a few moments just talking about basis period reform. This is quite a significant change in how, again, unincorporated businesses are going to be dealt with going forward in terms of the tax years and how that interlinks with accounting periods. So the businesses who will be impacted by this is basically all unincorporated businesses without a 31st of March or 5th of April year end. So we're moving to a fiscal year basis. But by concession, HMRC have said that a 31st of March year end will be deemed to be the same as a 5th of April year end. Now, per HMRC statistics, this already apparently covers off about 93% of sole traders and approximately 67% of partnerships. Estimated about 400,000 businesses will be affected. It's likely that the biggest impact of these changes will be on large and international partnerships. International partnerships in particular tend to have a calendar year as the basis for their accounts, and therefore they will be impacted by this. Seasonal businesses and farming businesses are others which could well be impacted for the reason of resource. Those sorts of businesses don't necessarily want to be tied up having to prepare their accounts in the summer months, but if they move to a 31st of March year end, then they will have to. Now, you don't have to change the year end of the business. You can keep the year end as it has always been and keep preparing the accounts to that same period. But the problem in doing that is that it is likely to create issues when it comes to calculating the tax liability going forward. And we'll explain why next. So just a reminder in terms of how things work at the moment. If you've got a business with a 31st December 2022 year end, the profits are taxed in the 22-23 tax year, and the tax return and payment is due on the 31st of January 2024. Similarly, if you've got a business with a year end of the 30th of April 2022, again, taxed in the 2022-23 tax year, and the tax return payment is due 21 months after year end. So a big lead time between when the accounts are finalised and when you actually pay the tax over in respect to the profits on those accounts. Now, under the new rules, and these come in from next year, remember, for a December year end, if you keep the business as a 31st December year end, then for 24-25, the profits to be taxed will be from the 6th of April 24 to the 31st of December 24. So they'll be derived from the 31st December 24 accounts. And then you need to include profits arising from the 1st of April 25 to the 5th of April 25. And these, of course, will be in the 31 December 25 accounts. Now, the filing and payment date for that tax return is the 31st of January 2026. So at that particular point in time, it's highly unlikely that those accounts for December 25 will even have been started, let alone having some figures which are meaningful. So estimates will have. So we do have these issues around the second accounting period, and estimates are going to be required in many circumstances. Now, HMRC were consulted and have consulted on possible solutions to try and make that position as easy as possible in terms of remedying it, and various different options were put forward. And the conclusion from that review is that the provisional figures can be amended now within the normal time frame to amend a return, i.e. 12 months from the filing date. So it's broadly that last bullet point there, leave the current rules unchanged, but rather than initially what the review said was the updated return would have to be filed as soon as the updated figures were known. Now what they're saying is you just have to file that return within the deadline for amending the return that was originally submitted. Now, as a result of moving on to the new basis period, 23-24 is going to be what's called a transitional year. And so in this period, we will have a doubling up of profits for a part of that period. And so what we have for 23-24 is what we call a standard part and a transition part. And the standard part is the first 12 months from the previously taxed accounting period. And then the transition part is the balance from the end of that date to the 5th of April 2024, less any overlap relief that may have been brought forward from previous periods. Now, as a bit of a relieving provision, because those profits effectively are being taxed sooner than what they would have otherwise have been, you can spread those profits over 5 years and therefore spread the liability over 5 years going forward. So by way of example, if you had a business with a 31st December year end, the 23-24, the standard part would be the year ended 31st December 23, as it would be normally anyway. But then we have these additional profits which are being taxed in 23-24, being the profits from the 1st of January 24 to the 5th of April 24. And so those transition profits will be from the 31 December 24 accounts, and the tax return for those is due on the 31st of Jan 25. So again, there will still be this issue around timing and having to use estimates initially to work out what that transition part is. Now, in terms of overlap relief, the big question there is, do we know what the overlap relief is for a business? Unless records have been kept well from when the overlap relief was generated, we won't have that figure necessarily to hand. And as I mentioned, this will be important because it's set off against the transition part of the profits in 23-24. And if it's not used against those profits, then it's simply lost. It cannot be carried forward. It is a very much a case of use it or lose it. Now, the Revenue have said that they will be issuing what they call a G form in the summer of this year. And this is a form where you'll go into the website and request the overlap figure for a particular business. It remains to be seen, how good that will be in terms of the service, but we just have to see what happens there. You can telephone the Revenue as well, of course, if you if you've got a spare 45 minutes or an hour to wait to speak to somebody and then hopefully get an answer. So that's all I wanted to cover from a business tax and corporation tax perspective. I'll now go on to cover thickest section, just looking at some private client matters. Quite a significant change was announced recently, in that from 23-24, the earnings limit to require to file a tax return has been increased from £100,000 to £150,000. Now, what should happen is those taxpayers are affected by this. They should receive a self-assessment exit letter following the submission of the 22-23 tax return, if those circumstances appear to apply to that particular person. Now, the one, or certainly one of the issues around this is that by not submitting a tax return, it is quite feasible that the taxpayer may well be paying more tax than what they would have otherwise have done. And one area where this could apply is around the tapering effect when the personal allowance is reduced. So when you go above £100,000 up to £125,000, you lose your personal allowance on a £1 for every £2 basis. And what that means practically is that any income in that particular band is taxed an effective rate of 60% because of the reduction of the personal allowance. So any deductions that you could claim that reduced your income in that band would clearly reduce your tax liability by 60%. So classically, gift aid contributions, pension contributions, that kind of thing. So there is a risk here that this could almost be a bit of a stealth tax in terms of not giving relief at that higher rate for those sorts of deductions. So in some cases, notwithstanding there's no requirement anymore to file a tax return if your income is below £150,000, it might still be beneficial to do so if you fall within those particular brackets in terms of income. Now, it doesn't exclude all taxpayers here. So some taxpayers will still have a legal requirement to file a tax return. And so it's those with whose income is under £150,000, but have self-employed income over £1,000. If they're a partner in a partnership, liable to the high income child benefit charge, or in receipt of any untaxed income. So that could be quite broad, really, in terms of bringing people back in. Just wanted to mention the deadline for paying voluntary national insurance contributions has been extended further. Now, this is something that's being championed quite heavily by Martin Lewis, of course, if you've been watching his program. And so this is a mechanism whereby people who have gaps in their NIC records can make contributions to plug those gaps and therefore maximize their entitlement to various state benefits. So the deadline now has been extended to the 5th of April 2025. Now, it is important because if those missing contributions aren't made by April 2025, it means you can only go back 6 tax years, whereas making those missing contributions before 5th of April 2025 means you can fill in those gaps back to 2006. So it could make quite a significant difference to the entitlement. So as a kind of a bit of an overview, insure men born after 5th of April 1951 and women after 5th of April 1953. Those are the key dates for people who could be affected by this. And making those additional contributions will boost their state pension entitlement. Now, the Revenue have said they are going to make improvements to the digital service on this, so hopefully it will be easier to update your records and make those payments, because it is a little bit clunky at the moment in terms of how you go about doing that. You have to telephone HMRC and then get a payment in reference and ensure that's matched to NIC records. So, you know, we are aware of payments kind of going missing or sitting in abeyance in places. So it isn't working ideally at the moment, but hopefully the online system will help with that. And just a couple of reminders around CGT, first of all, and we are still seeing some issues around here and this deadline being missed. Remember that for sales of residential property by a UK resident, you need to report and pay tax on the sale or disposal of that property or land within 60 days of completion. For non-residents, the scope of that reporting requirement is even wider, because they have to report disposals even when there's no CGT to pay. So for UK residents, it's only when there's a CGT liability. For non-residents, it's any disposal of UK land or property. And for non-residents, it also, of course, includes non-residential property as well, so commercial property as well as residential property. The other compliance aspect we just wanted to cover off was around the trust register. And this has been in for 12 months or so now. It is quite wide in scope. It can catch some unexpected situations. A couple of points to remember here: that taxable trusts do have to make annual declarations, and if there are any changes to the trustees, for example, or beneficiaries, then the trust register needs to be updated within 90 days of those changes. Now, at the moment, certainly our experience is that HMRC are taking quite a light touch as far as the penalty regime is concerned for the trust register, but I'm sure that will change, as very often happens when a new process is introduced. For the first 12 months or so, the Revenue tend to be quite lenient around non-compliance in terms of penalties. But I do think as we move into the second and third, etc., anniversaries of these requirements being in, that a more hardline approach may well be taken. Something of note, point of interest, more than anything else. There was a recent report out which indicates the Wealthy North unit collected more extra tax, investigating wealthy people than specialist teams elsewhere in the UK. So I don't know if that's through a focus or just the way things have panned out, but there we are. The North has been very productive from an HMRC perspective. So this unit, they scrutinise the affairs of UK residents with net asset wealth over £2 million, and who share income over 200,000 in the last 3 years. They are looking at high net worth individuals, about 700,000 UK taxpayers in total. Interestingly, income tax bills in parts of Cheshire and North Yorkshire are just as high as in many London boroughs and the home counties. I'm assuming Cheshire must be probably a direct relation to Man United and Man City players potentially. The focus has been on ownership of undeclared overseas assets, which is something the Revenue do clearly look at when, particularly with high net worth individuals. but just something of note there. And finally, on the private client matters, just wanted to highlight something that is very new, not hot off the press. Just a couple of weeks ago, the Revenue announced a new Spotlight, Spotlight 62. Now, Spotlights have been around for a number of years now, and this is where the Revenue become aware of a particular planning idea or a particular planning structure, and they issue these spotlights, which essentially set out their views on what the planning is, what it purports to do, and why they disagree with the tax effect that's the taxpayer believes they are getting from undertaking that planning. Now, Spotlight 62 is around what's called a dividend diversion scheme, primarily used by owner-managed businesses to fund school fees. And then the person who I believe highlighted this as being a promoted scheme was a guy called Dan Needle, who you may recall he was the chap who dug into Nadeem Zahawi's tax affairs whilst he was Chancellor and also being investigated by HMRC. So this is a tax avoidance scheme in HMRC's opinion. It's designed to divert income from the business owners to minor children. HMRC's view is the arrangement does not work. It's being actively promoted by a couple of firms, we understand. And in essence, HMRC's conclusion on this scheme is that it falls foul of the settlements legislation for various reasons. Now, if you've come across this arrangement or something similar, then you do need to look at what has been done and whether any kind of disclosure needs to be made to HMRC, and also if there's any way of getting extracted from that scheme. It is something the Revenue will challenge. Now, how it claimed to work, and this again is outlined by HMRC, is that very broadly a company issues a new class of share which entitles the owner to certain dividend and voting rights. A person, usually a grandparent or sibling of the company owner, purchases those new shares for significantly below market value, and then gives those shares to a trust or declares a trust over those shares for the benefit of the owner's children. Then, lo and behold, a few days later or a few weeks later, a substantial dividend is paid in respect of those shares, and is paid to the trustees of the trust. Now, as beneficiaries of that trust, the owner's children are entitled to their dividend and use their personal allowance against it. That's how it's purported to work. What the Revenue say is that income received by that trust is taxed on the parent under the settlements legislation. It's an income diversion type scheme. So just beware of if you've gotten clients or if you've been involved with this sort of arrangement. Disclosure may be required under the DOTAS regime, for example. Right, well, I'll leave it there. You've heard enough from me now, so I'll hand you over to Paul, who will pick up some interesting things that have been going on in the field of tax investigations and inquiries.
Okay, good afternoon, everybody. The areas within tax investigations and tax disputes that I want to talk through with you in the next 20 minutes or so are threefold this time round. The first of the three areas I want to spend a few minutes on is to talk through with you just about the extent now of HMRC's activity as regards research and development tax relief that, in their view, has increasingly, according to the statistics now available to them, included a significant amount of inaccurate claims for the tax relief, or worse still, fraudulent claims. And this has sufficiently got under HMRC's skin for them to divert considerable resource into this area. Their statistics show that for the 21-22 year, they estimate that there's £469 million of inaccurate or fraudulent claims for research and development tax relief, which is a significant increase in the previous period. And plainly, they are looking to dampen this down and to recover quite a chunk of that, if at all possible. You'll all be aware of just how long research and development tax relief has been in the UK tax system. And it was designed in the early days to promote, rightly, investment into research and development by businesses to further the education, the resource and the business productivity. Unfortunately, what has happened in the intervening years is that there has been a number of organisations who have seen that there is an advantage to making this claim without paying due regard to the strict criteria that needs to apply. And this is what now HMRC are turning their attention to. Last year, they set up a research and development, what they called an anti-abuse unit, to particularly look at this area. And this is with the direct and specific intention of looking at fraudulent and erroneous research and development claims for tax relief purposes. And I think a number of you as practitioners will have seen letters in the last 3 to 6 months, in our experience, of an increasing activity by HMRC under the banner of compliance checks, is how they normally headline them. But what we are now starting to see, which is quite ominous, is that HMRC have a particular unit known as their Fraud Investigation Service. Fraud Investigation Service. And we have seen very recently the content of one of these letters, which I just want to highlight with you to show the area now that HMRC are going down. And this is from a letter that was sent out in the last month or two to a practitioner on behalf of a client, where there is no hint, as far as we are aware, that there is anything incorrect in the research and development tax relief claim. But what this letter says is, HMRC believes you have fraudulently claimed money to which we, HMRC, believe you are not entitled. HMRC believes you have fraudulently claimed money. At this time, HMRC has not opened a criminal investigation into this suspected fraud. Now, this is serious stuff. This is dangling the threat of criminal prosecution in the event of HMRC pursuing a fraudulent claim. Now, this is not a fraudulent claim. They end the letter by then going on to say, HMRC reserves the right to open a criminal investigation into any suspected fraud committed against the R&D scheme. Now, quite what the thinking of HMRC is in sending this type of letter out from Fraud Investigation Service is unclear, because on the one hand, they are looking into this area through what they call their normal compliance check processes. But secondly, having then sent this type of letter out from a Fraud Investigation Service perspective, they end up by saying, well, they reserve the right if they feel the need to do so. And just as a footnote in this case, we have recently found out, as an aside, that in this particular case, HMRC, having sent this letter out, to which the practitioner and the client duly responded with reinforcing the basis of the claim, on receipt of that information, HMRC then saw fit to close the case and repay the tax relief as was first claimed. So there's no sense or logic to this. But the point of me raising this with you is to demonstrate the wide-ranging nature of HMRC's inquiry into what they perceive is widespread abuse of research and development tax relief. And we as practitioners have to anticipate that there will be quite a number of cases which, so long as they are handled carefully, there should be no difficulty with them. So as practitioners, do not be fazed by this type of letter. It plainly needs to be handled very carefully for obvious reasons. Another topic now. Over the years, HMRC has opened up what they've called campaigns. What they mean by that is they have seen an area of the economy or a particular type of taxpayer that HMRC believe haven't declared all the income that should have been claimed. Normally individuals, but not always, sometimes corporates. There have been a number of campaigns over the years. Now, normally these campaigns are only open for 12 months, 18 months at its fullest. But this one, the Let Property campaign, actually was first announced 10 years ago. And it is still open. And in fact, it was updated earlier this year. HMRC still believe that there are a number of residential property landlords who have not properly disclosed their income for tax purposes. And what the Let Property campaign does is to enable those, if there are any out there still, and HMRC's data indicates that they are still receiving significant amounts of tax year on year through this Let Property campaign. So if you have clients who, in the cold light of day, be it a single rental or multiple properties or student or workforce rentals or holiday lettings, any or all of those areas can be included within this Let Property campaign. And what is it? Well, it's basically coming forward to HMRC under quite favourable arrangements as regards how it will be handled by HMRC to settle the arrears. Now, interestingly, most campaigns and disclosures need to be done within a certain time period. For example, typically 90 days once the taxpayer via the agent has come forward to HMRC. But in this particular campaign, there is no disclosure required by any specific date. So HMRC are basically saying to the tax-paying public, if you have anything out there that you need to disclose, then do take this opportunity. Because what they are saying is that this campaign will be ongoing for some time. And the reason, or one reason, why they are going to keep it open for some time is that they are shortly going to be able to access quite a large amount of data which previously would not have been readily available to them. And this is all around. You may have heard in the press last month, this was a political matter as much as anything, and there had been a lot of pressure put on the government as to the rental sector generally, nothing to do with tax at this point. So last month, the Renters Reform Bill was introduced into Parliament. Now, the likelihood is, given there are quite a number of sensitivities politically within that bill, that it will take some time to go through the various debating chambers and committee stages. But sooner or later, it will be enacted. And at that point, there will be a private rented sector database set up. And what that will do is it will provide the basis for the future privately rented property portal service. And it will be publicly accessible. That isn't to say that HMRC will be given ready access to it, but it will enable HMRC, if they are minded, to access this, and you have to anticipate that they will. So they will see this as very fertile territory that they are going to very soon be able to access. The third area I want to talk through with you briefly is what's known as the Pandora Papers. Now, we're talking offshore here now. Do you remember the Panama Papers? It was back in 2016 when one of the major law firms in Central America, in Panama, known as Mossack Fonseca, had a significant amount of client confidential data made available, which enabled significant tax inquiries to be followed by a number of authorities around the world. We now have what's known as the Pandora Papers. And what the Pandora Papers are about is that in 2021 and 2022, the International Consortium of Investigative Journalists released more than 11 million records from 14 offshore service providers. And since then, HMRC in the UK has not only been in receipt of that data, but been able to now go through that as regards tracing and identifying UK residents who, on the face of it, have untaxed offshore assets. HMRC's instinctive position, as soon as they hear about any offshore asset holding, take it that it was done entirely from a tax evasion perspective. That isn't necessarily the case, actually, but this is how HMRC will view this. We have seen in a couple of cases recently where it was nothing to do with tax evasion that was the driving force and the reason behind overseas accounts being opened. They were set up perfectly properly for business development purposes overseas. And yet, because of the nature of the way the bank account was maintained, when that came to HMRC's attention, the letter that they sent out indicated quite plainly that they suspected that there were at least that there had been tax evasion, when in fact there hadn't been. So don't automatically assume that just because a letter is issued, it is a matter of having to defend tax evasion, for example. It may well be that it was done for good commercial reasons, quite apart from any tax saving that may have been incidental, in fact. But what HMRC are doing is, in the last couple of weeks, literally, they have started writing out to UK residents that they now have details of. And what they are saying in these letters is, how about us, HMRC, giving you the opportunity to correct your tax affairs? So how about making a disclosure under one of the disclosure facilities that they do make available and are still out there? And that is the way that this matter will need to be handled. The point here is that it is extremely important that individuals use the correct disclosure facility, as we'll see. There are two principal types of facility open to an individual or individuals who wish to make a disclosure to do with overseas assets and income. The Worldwide Disclosure Facility is one of those two routes. It is a more informal, so I'll say slightly less formal than the facility we will look at in a moment, in as much as the Worldwide Disclosure Facility is really designed to enable people to come forward who didn't undertake the matter deliberately. They didn't seek to evade taxes. They've done it carelessly, if you like, or perhaps by simple oversight in the cold light of day. And therefore, it isn't a deliberate action that they have done. And as such, they won't need any protection from prosecution. And indeed, the Worldwide Disclosure Facility does not provide protection from prosecution, but it shouldn't be necessary in a case that is handled through the Worldwide Disclosure Facility. And it is a relatively straightforward process. Yes, there's a degree of formality, inevitably, but it is the easier of the two routes. If, as an alternative, the matter in hand has been done deliberately, with thereby fraud in mind, then the Worldwide Disclosure Facility would not be the right road to go down. Instead, it would be, as we shall see in a moment, the Contractual Disclosure Facility that has to be followed. Now, this is a more formal process, but it is a process well set now in the tax system. And in summary, and we see these cases from time to time, we have cases on at the moment, it is a contractual arrangement between the taxpayer and HMRC. And in so doing, HMRC undertake not to criminally investigate the tax fraud committed, so long as the taxpayer makes a full, open and honest disclosure on a timely basis. In other words, the taxpayer says, hands up, I'm going to settle what I owe, and I'm going to do it on a full and open basis. It's part of what is known as Code of Practice 9. And it does enable the taxpayer to make a complete and accurate disclosure of all the deliberate and any non-deliberate conduct items as well in their tax affairs. Interestingly, Code of Practice 9 was updated literally last week by HMRC. They have sent out now an updated version, which is available on their website. And what that seeks to do is to tighten up, really, from HMRC's perspective, how they will see a Code of Practice 9 case being conducted. It is therefore extremely important to select the correct facility, as we've seen, dependent on whether it was deliberate conduct or not, basically. That will set as to which course of action is followed by way of making a disclosure. And the option to take will depend on the particular circumstances and the issues that need to be disclosed. So care needs to be taken plainly. And there, I think we have it.
Thank you, Paul. That was very informative as always. And thank you everybody for listening. I do apologize again for the technical issues that we had earlier. Thank you for persevering with us. Now let's just check. We do have a question in, and is buying a property and the fit out allowed within the AIA? The answer to that is possibly. The fit out costs, you would typically analyze those to look at what qualifies integral features, what qualifies general pool. Now the AIA can apply to both special rate pool, so integral features, as well as general pool items. So electrical works, that kind of thing could qualify for the AIA. The acquisition of the property itself, that will very much depend upon the capital allowances history in the property, and things like, Section 198 election, that kind of thing, in terms of what proportion of the property price you may be able to claim AIAs on. But certainly it's something that should be looked at with any property acquisition, both in terms of the acquisition itself and any subsequent fit out. And I think, I just wanted to actually just quickly go back to Paul's point around that FIS letter and the R&D claim. And again, just to build on that. Again, one of the frustrating things around that particular case was that a full R&D report had been submitted with the original computation. And so it clearly hadn't been looked at all. And in the response to the FIS letter, the practitioner basically said, well, the information the revenue asked for was in the report. So, we just submitted the report again that was submitted with the original tax computation. And so it just immensely, the whole process was just immensely frustrating from start to finish. But we are seeing, unfortunately, seeing some of that going on. Well, thank you again for listening. As always, we're more than happy to answer any questions you may have afterwards. So please feel free to drop us a line. Be delighted to answer any other queries that you have. And also for future webinars, we're always looking for topics to talk about. We pick topics that we think might be of interest to you. But please, if there's anything that you feel you'd like covered, we'd be delighted to look at that and incorporate those into future webinars. So look forward to seeing you again in September if we don't speak to you beforehand.